All right, so welcome to the webinar today. This is the webinar where we're going to be talking about asset classes. So asset classes for apartment syndication specifically. And so we're going to be diving into what is a class A, B, C, D, and some of the different nuances between each one of those so you can be a little bit more knowledgeable and familiar and understanding of each one of those different classes. And so today, before I get started, I wanted to talk to you first. Well, let me back up for just a minute. I always kind of get ahead of myself because I just always think that everybody knows a little bit about who I am. So I'm Dan Handford. I'm one of the managing partners of a group called PassiveInvesting.com. I'm also the founder of this group, the Multifamily Investor Nation. And if you want to find out more information about our group, you can go to PassiveInvesting.com. And when you go to PassiveInvesting.com, you can actually click on, just for those of you who are joining us live, I just typed into the chat box there the link, and you can click on this Meet the Team, and you can see my bio video here. And our other two managing partners is Danny Randazzo and Brandon Abbott. You can go ahead and click on my name right here. There's a video here that dives into a little bit more details about myself and my background so you can have an understanding of who I am. And then if you're interested in joining us on one of our future properties and future investments, you can actually click on this Join Passive Investing Club to join our club if you wish to be able to see some of our future offerings. We do have one offering available right now, and right underneath there's a little button. You can click on Current Offering. If we have multiple offerings, it'll say something a little bit different, but right now we have one offering available for you, and this is a 506C, and so we can only accept accredited investors on this. But when you click on it, you will see the landing page that we've put together for this particular deal called Braxton Carey Weston. And for those of you who want to find out more information about that, who are on us live, let me go ahead and type it into the chat box for you as well. And you can click on that link and find out more information about this particular deal and the different return metrics and things like that. And if you want to have access to the offer memorandum and you're an accredited investor, you can fill out that form there and we will send it over to you. So let me go back to what we were talking about over here. So that's enough about me. Let's talk about the asset classes for apartment syndication. And I wish I had a table put together for you. And I thought about doing this, but I don't have a table put together for you so you can actually see this is Class A and the differences between B, C, and D. But we're going to talk about them on a high level so that you can understand each one of these things. And then as we go forward, if you have further questions for me or anything like that, we can obviously dive into a little bit more detail when it comes to each one of these various asset classes. Now, one of the things that you'll realize that, well, one of the things we're going to talk about is what are the differences. We're going to talk about where do you really want to be? What are the different asset classes and where the risk levels based on those asset classes and some of the return metrics that each one of them will actually have as well. And so let me see if I can find something here. Give me 1 second here. Let's see. Give me just a moment. Let's see. I'm not finding this thing that I was looking for. All right, so let's do this. So let's dive into this. So what is Class A? So when you think about Class A, you have to think about Class A as like the top of the line, the best apartments, the best assets that are out there. And they're usually built within the last 15 to 20 years, somewhere around in there. Sometimes when you try to get to that 20-year range, depending on how well the prior owner has maintained that asset, it could start to get closer to like a B plus, if you will. But for the most part, that 15 to 20-year-old property is going to be in that A class range. Now, it's not always about the age because it also is about the types of amenities that are inside of an asset as well. So I know some people right now that actually develop Class B apartments. So they actually build brand new Class B apartments, which means that there are certain upgrades and amenities and luxury upfits that, if you will, that they just don't include when they are developing a property. And that's what we would call a developer who is building for a certain class of property. So it's not always about the age, but that is one of the factors that you can consider. Especially now, like most of the new builds, new constructions that are happening right now, you can pretty much build to whatever asset class that you want. Mostly you'll see either a B class or an A class property being built right now. And depending on how well that asset has been maintained will also allow you to think about that. Let me actually do this real quick. I'm going to do my whiteboard presentation here, and I'm going to give you a little bit of an idea as to a different way to look at some of these different metrics that we're going to talk about. So let me just bring this down here and get my correct color that I want to use. I usually like to use like a blue of some sort. So you guys can see this. Raise your hand if you can see my scribbling on the whiteboard, just to make sure that everything is working great. All right, perfect, awesome. Thank you so much for that. I'm gonna remove my little chicken scratch there. Appreciate it for those of you raising your hand, let me know. And so we're gonna talk about these asset classes. And so we have these A class assets, right? And if you go down the level, we have A, B, and C, right? So we're just gonna say, and let me just tell you about D real quick. We're not going to probably touch on D that much, but D is those areas that you just don't invest in, right? That's like the D zone, right? So that's where you're going to see a lot of drugs, and you're going to have a lot of crime, and it's just not an asset class that I would recommend that you get involved with. So we're only going to say A through C. Those are the three main ones that you're going to really see on a regular basis. But D is one that's just on the lower end. The properties are dilapidated. They might even have boarded up windows. I mean, those are the properties that you want to stay away from, right? Nobody really wants to invest in those, which is why which is why they are where they are. Normally, if someone's going to buy a D class, they're going to probably bulldoze it and build brand new, right? That's typically what's going to happen. A couple of things that I'm going to put here on this chart, on this little whiteboard presentation is, these are the nicest, right? These are going to be nicest. And then these are going to be, I'm going to say not so nice, right? Not so well kept, right? I know this is kind of maybe it's a little bit elementary, if you will, but just bear with me here. So these are going to be your nicer asset classes, and then you're going to have your B classes, which are going to be middle of the road, and then you're going to have your not so well kept properties, which are going to be your C class properties. Now, I have seen some properties that are C class that have actually been fairly, clean and organized and things like that, but you can just tell by the structure and the makeup and things like that they are a C class property. Now, and if you think about C class as well, a lot of times if you go into a city or an area and you are in, if you know that city well enough, like I'm here in Columbia, South Carolina, and I can tell you in this area, in this market, which areas of the city are the old city, if you will. So that's the areas where there used to be about 40 or 50 years ago is where a lot of stores were opening up, and there's a lot of stuff happening, and there's a lot of traffic, and all of a sudden, as the cycles go throughout, that area has gone down, and there's another area where all the different new builds and new stuff is going. And this is going to be where those C-class properties is located, is in those areas that are kind of the old city style areas where it's not going to be the most up-to-date, most modern areas. You're not going to see a Starbucks around the corner usually. Okay. Now, the other thing I wanted to mention here is about the investment returns that you would see. So typically, in any type of an investment, the higher the risk, the higher the reward, right? The higher the return. It's the same thing with these types of asset classes. And if you understand this kind of nuance, you'll be able to better understand the risk profiles when you're looking at it in an investment as well before you invest in it. So here you're going to have lower risk is going to be in your class A's. Okay. This is going to be, let's talk about risk. I'm just going to put this out here off to the side. So this is the risk. Okay. You have lower risk over here, and over here, as you go out, this is going to be higher risk. Okay. And then you're going to, and let me explain that a little bit too. So because you have a newer property, you're going to have a lot lower amounts of deferred maintenance and potential things that are going to happen on the property that are going to be unknowns. And as you go down from A, B, and C, when you get to that C level asset, it's a higher risk because yes, you might have a business plan that's going to achieve 20% returns, but there's going to be a higher potential for that business plan not going as originally planned because there might be some additional CapEx expenditures that just come up or a mainline water break, and things are just aging out and they're going to have to be replaced. And you can't underwrite for it because you never know what that kind of stuff is going to happen. And so you do have a higher risk with those C-class properties. Now, let's now look at return, right? So we're looking at an overall return metric and primarily looking at this from the investor's perspective, the passive or the limited partners perspective. Because you have lower risk, what are you going to have, right? Well, if you have lower risk, you're going to have lower return. If you're going to have a higher risk, you're going to have a higher return, right? And so same thing, this is going to be a lower risk, lower return, and then you're going to get higher returns as you go up. And this is why it's important, even inside your real estate portfolio, to not just have all of your eggs in one basket. So I see a lot of people, they'll put a lot of their eggs in this kind of C-class asset because they have this potential for these higher risk and higher reward type potential returns. The problem is that the likelihood of these actually coming to fruition is a lot lower than these over here, and these have lower risk. And so if you heavily weight your portfolio in C-class assets, when you have times like we're seeing right now with COVID-19, the C-class assets were the assets that had the most, saw the most impact when the economy started to shift. And then, so hopefully that gives you a better idea as far as like the risk versus return and things like that. And the other things that you have to think about when it comes to these A, B, and C is the A-class assets. There's actually two different types of A-class assets. There is the really high-end urban infill downtown, type of A classes where the rents could be, $4,000, $5,000, $6,000, $7,000, $8,000 a month, right? And those are the assets that have the most exposure when it comes to a downturn or correction, because those people can now will likely leave there and go to a nicer, not nicer, but a more suburban or lower end A-class property, or what I like to call an affordable Class A. And that's kind of what our group looks for when we look at Class A's. We're looking for an urban, we're looking for a suburban kind of out of downtown. Average rents are between $1,300 to $1,600, $1,700 a month. And that way we're not that far off from a Class B asset. So the economy does have some form of a shift or something like that. We don't see this major shift of people going from our Class A's down to a Class B. It just doesn't happen, right? And if you look at the data doesn't even support the shift from a Class A property down to a Class B and B to C or whatever. There's a little bit of a shift, maybe 30, 40, 50 basis spread from one to the other, but it's not a significant shift, especially in those suburban Class A properties. As a matter of fact, the suburban Class A, because there's two different levels of Class A, those people who are in those higher end Class A's that are paying those $6,000 or $7,000 a month will go down and to a nicer class. I don't want to say a nicer Class A. They'll go into a nice Class A that's in more of a suburban feel, and they'll pay, $1,300, $1,400, $1,500, $1,600 a month for those, because they're still saving a significant amount of money by doing that, but they're still in those nicer assets at the same time. Now, when you get into the B class assets, those are going to be more, I'll probably say 19, you can probably get a nice B plus, not a B plus, but a B class asset, 1980 to about 2005, ranging from, B minus, B to B plus. And those assets are going to have fewer amenities than you would normally see in a Class A. They're starting to get to the point where they're starting to have more and more as we go throughout time, trying to get as close to those Class A's as possible. But the rents are still a little bit cheaper, a little bit cheaper than those Class A's. But there's a lot of people that will still want to, rent when they're getting close to those Class A prices in a Class A asset, because it's a newer asset and they know it's going to be, probably a lot better for them as far as not as much maintenance and things like that going on as well. Now, and then we get into the C-class assets. The C-class assets are going to be those assets that are pretty much anything below 1980s. So you're going to be, 50s, 60s, 70s, somewhere around in there. And it is still possible to be into the 80s with a Class C property, because I've seen some properties that have just not been maintained very well, and they're 1985 vintage, but they're just a C-class property at that point because of the amount of deferred maintenance and the amount of the upkeep that has just been not happening on that property, and it can go down pretty quickly like that. Those are kind of like a sweet spot, if you will. If you could find a property that's like that 1985 to 1980 to 1990 vintage property that just the owner hasn't taken very good care of it, and it's really a Class C property, there are some things that you can do to actually change that property and the dynamics of it to be able to get it to a point where it's actually a Class B minus at the very least, B minus property, and start to compete and be able to raise those rents. Those are kind of those sweet spots, or if you will, a unicorn when it comes to multifamily. If you could find that, that would really be a good sweet spot for you. There's still the potential for those, unknowns that come about, because if you buy a property from an owner that has not been maintaining it and keeping it up to date, then it's possible that after you buy the property, there's going to be some things that might come out that are unknown. So just make sure that you have enough in extra operating reserves to be able to mitigate some of that downside risk when it comes to that as well. So that's kind of the general ideas of A, B, and C class properties. So I want to open it up now to see if you have any questions as it relates to these different assets, because there are obviously lots of different nuances when it comes to A, B, and C. It's not a hard, fast rule of A's is always going to be this, B's are always going to be this, and C's are always going to be this. But you want to kind of have an idea as to what are these different levels. And I've seen some people put out offerings that are really true C-class properties, but they label them as B just because they know investors might want to invest in a B versus a C. So as a passive investor, you have to be aware of that and make sure that you can actually at least go do a Google Maps tour, or if you're local to that market, go in and actually understand what that property feels like when you go to the property. If you're local, just go drive by the property, right? Or you can reach out to the other surrounding competitive properties. If you call a competitor property and say, what kind of an asset is this? Would you call this one an A class or a B class, whatever? They'll tell you, right? They'll tell you what they are, what they think they are. So that's especially if you call the competition, right? All right, so I got a couple questions coming in here. And it says, George is asking how to rate the neighborhood by class. So the neighborhood is going to be very similar to that, A, B, and C. So an A class area is going to be an area that has a lot of development happening. There's new retail and new districts and new jobs coming into that market. And so you're going to have that higher end property and those higher end area, the asset, not the asset, but the higher end neighborhood, if you will, like you mentioned there. And then same thing with your Bs. It's going to be one that's maybe 10 to 15 years since it's been built up. And then your C class properties is going to be probably closer to 30 or 40 years since it was built up as well. Can you give a rent range for each asset class? So it's hard to really tell for sure what it is, but I'll give you a general range, if you will. But this is not a hard, fast rule, because there's so many different nuances when it comes to every different market is just a little bit different. Because what I see is here in the Carolinas, which is where I'm located, and this would apply really for Georgia, Tennessee, North Carolina, South Carolina, and also in kind of the Florida markets as well. The C-class range of properties is going to be close to about, I'd probably say anywhere between about $500 to $900 a month, give or take. And then your B-class properties are going to be between about $900 to about $1,200, maybe $1,300 a month, depending on which area you're in. And then your A-class properties are going to be that $1,300 to $1,700 in the suburban A-class. And of course, your urban A-classes are going to be a lot more than that. They'll be $3,000, $4,000, $5,000 a month. can you discuss cap rates for each class on average? Well, it's really hard right now, Suzanne, because a lot of the cap rates have compressed so much in all the asset classes, which is one of the reasons why we like to be in those B plus. Our group likes to be in B plus with value add or an A class property, suburban A class property. And it's because the cap rates are not that much different in each one of these asset classes. And many of the really strong markets like your Charlotte MSA, your Raleigh, Durham, Chapel Hill, kind of triangle MSA, your Atlanta, Georgia, Jacksonville, Florida, a lot of those markets, even Dallas and Houston and Austin and San Antonio, a lot of those markets are finding that these B class, middle of the road B class and B minus properties is not that much different than a B plus or an A class property right now. The cap rates are trending between about 4.5 to 5.5%. And some of these B class properties. So when you start to talk about thinking about buying an A class property that's maybe 4 to 4.25 is not that far off from a B class property. And then your C class properties, I've seen some C class properties trading in the mid fours. And these are for these the higher number of units. These are going to, 150 to 200 units or more. You're going to start to, you're not going to see as much of a difference in there. And so it's starting to kind of get so compressed that there's not a lot of difference there, which is why I think in the current climate, in the current market, the best two asset classes to go after are B plus with value add and your suburban A class assets, which have affordable Class A rents as well. How does the interest rate affect these asset classes and as far as the value is concerned? So right now, obviously, the interest rates are compressed as well. They're really low. They're at all-time lows, and so it's going to continue to affect the compression of those assets as far as the cap rates itself. The cap rates are going to be compressing, which is going to cause the values to be able to increase as well. And of course, the Fed is projected that it's going to be a long time, a couple of years before they start to increase those rates. So I think what we're going to see is we're going to continue to see that these cap rates are going to stay compressed for several more years, if not, for the long term. Are you leaning towards Class A now more than Class B? And if so, what are your reasons? I'm leaning more towards, Kevin, more towards the assets that I feel like make sense right now in the current environment because the cap rates are not that much different. Now, if you start to go into a lower end secondary or tertiary market, you can find some cap rates that are a little bit higher than that, maybe 6 to 7%. But at the same time, I try to find markets that I can have a high potential on the exit as well. And I want to have a market, if I'm going to bring on a lot of investors onto it, I want to be in a market that I know and I can pretty much, be almost guaranteed. There's never a guarantee, but be guaranteed that there's going to be new jobs and there's going to be blue chip corporations that are surrounding that market that create stability in that market. And that's really what we're looking for. We're still going after those B plus with value add. So we're still in the B classes, but I still want to be on the higher end of those B class assets. Let's see. Have you hired people off of Craigslist to drive the property and record a prospective renter tour? I have not, Colin, but I have actually heard people doing that and doing it quite successfully. It's a great idea to be able to do that. You can easily put an ad up on Craigslist and give them a little thing about what you want them to be able to do, as far as to go in to pretend that they're a resident and getting a tour, taking pictures, video, and then also around the area as well. Another good thing to do is to have them also drive by the property at night and kind of see what happens at night when all the residents are at home. Is there a lot of action happening, or is it very calm and kind of quiet type of community as well? What's the current expectation for as price per door? The price per door, Alfred, is usually all over the place. So it's kind of hard to really give a number when it comes to that, because depending on the market, it's going to really fluctuate quite a bit. So the price per door is a little bit harder to kind of give you an idea on right now. How to rate the neighborhood by median income? You could certainly try to do that. Typically, your your median income for a Class C property is going to be anywhere between 20 to 40,000. Your B class areas are going to be anywhere between about probably 40 to maybe 60,000. And then once you get to that 70,000 plus, it's going to be more inside of those Class A areas. To give you an example, we're acquiring the property I mentioned earlier, this Braxton Cary Weston one here. And for those of you who didn't see this one earlier, you can click on that to kind of find more details on this one. This one is actually a B plus asset with value add in an A class area. And the reason why it's in an A class area is because there's a lot of money happening going into this market. I think the average, I can't remember exactly. Let me double check this real quick. I believe the average income around this property is just over $100,000. It's like 107, I think. Let me just double check these numbers, so I don't want to tell you wrong. Yeah, here we go. So the average income surrounding the property is the average household income is $113,000. The average median, not the average, but the median household income is $84,000. So we're kind of in that A class area when it comes to these types of if you base it, George, on median income. All right, looks like I have one more question in here, and then we'll go and wrap things up for the day. We do have another webinar coming up next week. We're going to be changing the date a little bit, the day of the week. So instead of it being on Thursday next week, which is what we typically do, we're going to be doing it very similar to the way we did it this week, where we're going to be doing it on Tuesday next week. So we're going to be talking about tax advantages for passive and active apartment investors. So that's going to be Tuesday next week at 11 a.m. And so for those of you who are joining us live, let me give you the link here so that you can actually register. You can click on that link that is typed in there for the webinar coming up next week, which is on these tax advantages for passive and active apartment investing. So George's question on here is about how would you recognize the viability of scrapping some or all of a property in a Class A area to replace with high rise? Well, I think you're going to have a hard time doing any type of Class A high rise outside of some form of a downtown kind of urban style feel, unless there's a lot of other high rises happening in other areas. But I'm not an expert when it comes to the development side of multifamily, but I know that there's a lot of people out there that do look for those kind of the highest risk deals you can possibly get into, which is development. So we didn't even talk about that type of a risk profile, but development has a very high potential for very high return, but you have the highest risk of all of the different asset classes out there because you have development that's happening. There's a lot of things that could go wrong. And you also have the potential for it not executing the way you want it to, right? There's a lot of things that could happen from a debt and equity standpoint, but also from a municipality and local standpoint, the local government. There's a lot of things happening there. Plus, it doesn't cash flow day one. So I like to buy properties that are cash flowing day one, and development properties don't cash flow day one, right? They usually take about 2 or 3 years to really fully realize the returns for leasing up a property after you've built it up. Last question here is from, I know I said that was the last one, but there's another one here. Hussein, you asked about, can a passive investor be a corporation? And the answer to that is yes. As a matter of fact, we actually have a lot of corporations, a lot of entities, LLCs, things like that, that will invest inside of our properties and as an investments. And then it would also be, yes, Justin, you can share the link for the next webinar on LinkedIn. That would not be a problem at all. So, but yes, you can be a corporation, but we also have a lot of 401ks and IRAs and things like that. These trusts and self-directed IRAs that are these self-directed retirement accounts. And we also do trusts as well, but they will also invest inside of our assets. So you can certainly do that. We do have a maximum amount, Hussein. It's usually based on the deal. I believe this one that we're looking at right now, the maximum investment is $3 million. The minimum investment in our properties is $50,000. So the minimum is $50,000. The maximum is usually about 3 or 4 million. It depends on the size of the asset and how much equity we're trying to raise as well. All right. Well, thank you, each one of you, for joining us here on the webinar. I appreciate you, and look forward to seeing you here next week on Tuesday next week. Remember, next week it's at 11 a.m., not 12 p.m. Eastern like we've been doing. It's going to be at 11 a.m. Eastern Standard Time, and we look forward to seeing you next week on the next Multifamily Investor Nation webinar.